How is everybody doing? Welcome back to the Banker Next Door. I am your host, Dr. Joe Berquist. I hope everybody's been enjoying the holiday motif all week long. I'm kind of bummed out. This is my last episode, or I should say last episode getting to use the whole little bit of holiday motif. I think next year I'm going to go a little more grandiose, a little more over the top than just my little Christmas lights here hanging out and some red and green lighting effects. I need to plan a little bit more ahead of time next year. But again, I hope everybody was enjoying the little decor, a little bit different look this week as we've gone on. So yesterday I did an episode where I brought everybody kind of PCBB's 2024 year in review. Today I want to bring you PCBB's president's top predictions for 2025. Thought it was a great way to kind of close out the week here. So I'll bring up the blog post here. So this is again PCBB's president's top predictions for banks in 2025. So they basically interviewed the PCBB president, Mike Doren. If I'm saying that right, I hope I'm not butchering his name, Mike Doren, about the key trends he anticipates affecting banks in 2025, including regulatory changes, mergers and acquisitions, lending trends, and technology. Okay, so let's start with regulatory changes. With the Republican Party set to take charge of both the executive and legislative branch of the federal government in January of 2025, expectations for regulatory reform have shifted, according to Doren. It's too soon to determine specifics, but some of the things that were going to occur next year are likely to be tabled, he says. Open banking, both as a compliance necessity and a business risk, will affect banks in the coming year. Open banking makes it easier for consumers to leave a bank, and I think we'll see more individuals in small and medium businesses having relationships with multiple banks. It will be challenging for banks to keep market share, Doran says. CFIs that have used debt at the holding company level may need to re-engineer it in 2025. Many banks took on trust preferred debt at the holding company level between 1998 and 2008. As some of these near maturity, banks need to develop a repayment or replacement capital strategy. Early users are within that 5-year window, Doran says. Those that haven't paid off the loans may look to refinance. They may not find new debt that's as affordable or as accessible as the old debt because rates are higher and bank-to-bank credit isn't as readily available. I think that this is a fascinating topic, this use of trust-preferred debt at the holding company level. This was a huge issue many years back, going back to like 2010, 2011, 2012. There was a lot of focus on this. And I will definitely, in the new year, I will do an episode on trust preferred debt. I'll talk about that. I'll explain it, kind of get into that whole situation. Open banking. I know there's already been some lawsuits filed against that. I am not, like you guys, anybody who watches these episodes knows I hate open banking. I'm not a fan of open banking. I think the lawsuits will fly here in the new year, and I'm hoping that open banking gets shut down and tabled because it is a horrible, horrible thing for the industry. It is not going to be good for the industry. It's not going to be good for consumers. And anybody that paints it otherwise is lying to you, flat out. So okay, now let's move on to the next thing. Mergers and acquisitions. The coming year will likely see more M&A activity, in part because bank stock values have gone up. Many boards have an expectation around what their bank is worth, and when valuations go up, new numbers are more likely to square with their own ideas. Higher stock prices also mean that sellers can deliver more value to their stockholders. That may be especially true for banks that haven't found other ways to grow. They might lack a business niche, have lost customers to competitors, or have aging leadership teams without a clear successor. In these and other circumstances, M&A could be the clearest path to growth. Increasing numbers of bank M&A deals involve credit unions buying banks, a trend that continued in 2024. Doren expects it to last into 2025 unless regulations slow the trend. Without the tax burden of a bank, credit unions are often able to pay more for a bank than other bidders can offer. So again, very interesting topic there with that one. I'll definitely have a lot more to say on that as the new year comes in. But couple things with that, couple things with mergers and acquisitions. One of the big problems there is that the regulators under the Biden administration really slowed down the M&A activity just simply by gumming up the process. They made the process much more difficult. They made it last way longer. Just the length of the process itself killed a lot of deals. Or banks looking at the potential length of the process killed a lot of deals. So I just think that item by itself, just taking the process back to the normal process, a 12-month, 18-month process at the most, just getting back to a normal process with a normal flow, allowing mergers to proceed forward. I just think that in and of itself will increase merger activity. Then if bank stock values do go up, because I think the last couple of years, M&A, as I've reported on, has been rather depressed. There's only been about 100 or so transactions each of the last 2 years. So I think there is definitely there's a lot of pent up demand. It's just going to be, I think, the combination of reduced regulatory burden, increased, hopefully, bank stock values go up, and then I think you'll see a lot of M&A. You could see a big year for M&A. You could see 200 plus transactions next year. So we'll see what happens though. But I do think that credit unions buying banks, that could get shut down. There's a possibility that aspect of it could get shut down, but shut down, not shut to shoot, shut down. But we'll see what happens there. Loan quality and small business lending trends. So banks' loan volume has been growing slowly over the last few years at a modest annual rate of 1 or 2%. Doran thinks that loan demand will increase in the coming year. That's partly because of the relieved uncertainty around the 2024 election. Borrowers and banks tend to sit on their hands in the run-up to the presidential election every 4 years. He says there's usually a lag in all kinds of decisions, a little bit of a backlog that occurs before the election. With more certainty around election results, businesses move ahead with projects, and that often means borrowing. An upturn in borrowing also follows the Fed's interest rate cut and intention to slash rates further. The long end of the curve on 10-year Treasury bills has moved up while the short end moves down, which is normal when the Fed starts cutting, Doran says. The overnight rate has also gone down. Borrowers with adjustable rate loans and financial sector firms will likely benefit, as will construction businesses, revolving loan borrowers, and commercial and industrial customers. Interest rates will also affect borrowers with loans coming up to maturity. A lot of past transactions happened at the bottom of the rate cycle, Doran says. Unless the cash flow or value of the asset they finance has improved, borrowers won't be able to refinance and have the same outcome. Borrowing is more expensive than it was, and some borrowers will have trouble refinancing loans even at lower rates. Ultimately, Doran says CFIs won't successfully compete on interest rates against big banks. Instead, they need to figure out how they'll use digital methods to deliver the high-touch service their customers want. Commercial real estate had rough patches in 2024, particularly for office properties, which will probably continue to struggle in many markets during 2025. Industrial, warehouse, and distribution businesses are all opportunities, thriving as consumers order more goods for home delivery, and firms need places to warehouse the orders. The multifamily residential market is frothy, Doran says, with demand in the many places that don't have sufficient housing. The demand for middle market housing is strong, he says, adding that there is less call for luxury housing. With an aging U.S. population, senior living and its many categories that transition from active living to situations offering more care are a growing asset class. I agree with most of that. The one update I would have on that is that we basically know now the Fed reduced interest rates by 100 basis points, and they're saying that they may do 50 basis points cuts, another couple of 25 basis point cuts, probably every 6 months in 2025, maybe. So I think the reality is we are stuck with higher rates. I think definitely on the residential side, borrowers are going to be looking at 6, maybe even 7% mortgage rates throughout pretty much the whole year next year, I would imagine. And on the commercial side, rates aren't going to be much better. I say you're going to be looking at 6.75 to 7.75, something in that range on commercial mortgages, term loans, equipment loans, that kind of thing. So we'll see what happens there. I think a lot of borrowers are going to run into issues trying to refinance, trying to roll debt over. I think that will be an issue next year. So more to come with that. But I agree with what he said at the very beginning there. I think something I have noticed in the business is that over the last 3 election cycles, the number of people putting things on the back burner, so to speak, has gotten a lot worse because the two parties are so divided and so polarized. One party's going to do this, the other party's going to do this, and it creates a tremendous amount of uncertainty. And I think that especially the 6 to 8 months leading up to the election, a lot of people just this is what I've noticed over the last 8 years, is that people really put a lot of projects on hold and they sit on stuff. But now that the election's over, people are a lot more certain about what's going to happen in the next 4 years. So I would agree that I think you will see a bump in the beginning of next year. You'll just see that backlog of things that have been held off for the last 9 to 12 months. I think you'll see a kind of a flood at the beginning of the year. Then what happens with interest rates, I think, is really going to determine what goes the rest of the year. Because if people, we've got this debt wall, if people can't refinance their loans, there could be some problems there. There could be some delinquency, some charge-offs. We'll see the second half of 2025, we'll see how people are feeling. We'll see if maybe the Federal Reserve changes their mind and starts to decrease rates more. And then technology and AI. So banks are basically just beginning to tap the possibilities of artificial intelligence and machine learning, and large banks in particular can find a lot of value in it. Doran says a lot of focus on how we can get better insight from customer data around behavior and transactions in 2025. For instance, AI has the potential to help CFIs connect data that's spread between different silos. Banks have struggled with data housed in legacy systems that weren't built or designed for the current operating environment, Doran says. I'd start by looking at a CRM solution and a system that contains transaction data. See where you make more money. Why do you make more money there? Maybe you should get more of those. AI can also help free employees from rote and repetitive tasks, so that they're free to take on more valuable and interesting projects. It can help CFIs detect fraud and make credit decisions. The new technology is an implementation challenge for most organizations. That's to say the least. You need a person or a team that's devoted to finding opportunities, Doran says. Existing employees already have full-time gigs, meaning that, you're probably going to have to hire more people, maybe more specialized people to go into these things. So yeah, in general, I agree with the technology and the AI thing. Banks are already investing in technology. They're just going to do more of it. The AI thing is tough. Especially when you look at I think there's much more, fraud detection, great, no problem there. Credit decisions, that's a bigger issue because of the potential bias that could be in the system, all that kind of stuff. I think that's a much, much bigger challenge. It's a heavier lift, as they say. So, but okay. Regulatory changes, mergers and acquisitions, loan quality and small business lending trends, technology and AI, all great topics. I think he pretty much hit the nail on the head. A lot of great things to look forward to here in 2025. A lot of things happening. I would buckle up because I think 2025 is going to be a wild year. So, all right, with that being said, next week is going to be New Year's week. I have a couple things in store. I think on New Year's Eve, I'm going to do a review episode, kind of review all the things I did on the podcast this year, all the different series, different episodes, different topics, different interviews, just do a whole recap. I think I'll do New Year's Day. I'll probably do some type of an episode where, I'm going to get into, what's to come. What am I working on here at the Banker Next Door for 2025? Some of the different things we'll hopefully be doing throughout the course of the year. I have some pretty fun things coming up in the pipeline, as it were. So stay tuned for that next week. I'm going to try to do a live show. I could not, because of different family obligations, things going on this weekend. I could not do the normal weekly strategy room live stream on Saturday night. I'm going to try to do that on Sunday afternoon. I have scheduled it but we'll see what happens. I'll like I said, I'll try to put a post. If I'm not able to do that live stream, I'll let everybody know. But hopefully, I will be able to get it in on Sunday afternoon. So keep an eye out for that. And then, but like I said, we'll definitely be back next week with more episodes, and then the strategy room that following weekend, that first weekend in January, will pick up at its normal time on Saturday night at 8 o'clock. So with all that being said, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. Make sure to check out some of the other content on the channel. I hope everybody had a great Christmas. I hope they're enjoying the holiday week, and have a great weekend. Enjoy all the football and everything else going on right now. And I will see everybody again real soon. Thanks a lot.